Hi everyone, the smart investor here. That's me, I guess. And maybe you. So, why should you be listening to me? You should be listening to me for several things. First of all, experience, right? I teach this stuff, I invest in this stuff, and I've been successful at this stuff, right? Take a look at my $1.7 million portfolio that is up 34% over the past 2 years, okay? Now, and I've got a bunch of stocks, and I'm starting to put some options in it. Now, why do you need to listen to me? First of all, and second of all, is that I'm not selling anything, okay? And I'm explaining the thing to you. I'm not telling you what to do, right? I mean, I could have a bunch of people coming in and telling you, well, this is what you should be doing. The Fed is doing that. The Fed is going to lower rates, but we're going to be in a recession. You got to sell everything. And next thing you know, oh, you know what? It's okay. It's not happening. The Fed is lowering rates and we don't have a recession. Therefore, it's time to buy something. I mean, it depends how you look at things, right? It's either one way or the other. The most important thing, you need to understand what is driving this thing. And like I said all the time, don't try to predict the market. Don't try to predict the market. What you need to do is you need to take advantage of the market. How do we do this? Right now, today, right? They said, oh, look, we have a huge unemployment going up. Oh my God, we're going to have a recession. Oh my God. Okay, but that means that the Fed is going to lower rates. Isn't that what you wanted? Remember what I told you in a couple of videos ago? Be careful that the way we look at rates, right? We're expecting rates to go down, right? So stocks went up. But now what's happening is they say, well, hold on. Yeah, but we want our cake and eat it too. We want rates to go down. So then you have to invest in stocks. You're not going to buy at 2% of anything. But we don't want a recession either. Because if I have a recession, then forget the rates. We're going to see how fast it's going to lower because now we're in trouble. And don't forget, this business with the rates, it depends on the Fed, right? Probably the Fed, you could argue that the Fed has too much power at this point. I mean, at the end of the day, the Fed is supposed to be here just for one thing, is to make sure we don't lose the value of the dollar. The Fed is not here to make sure you have a recession, not a recession, getting involved in taxes and fiscal policy and all that. Unfortunately, we're starting to look at them that way. You've got to start thinking in those terms, right? The Fed is only here to fight inflation. And so far, I hate to say it, but they're doing a pretty good job. We were at 9% at one point. Now we're down to 4%. I mean, they're looking for 2%. So it is working. The Fed is not here to prevent a recession. Okay, so you can't tell them, you got to lower the rates faster because you're going to put in a recession. Technically, that's not their job. That is not their job. So, all right, so how do I make money in this process? Well, it's actually fairly simple. Right now, because we don't know what's happening, because we're uncertain, play the volatility. Stop panicking. Do not panic. Play the volatility. How do you play the volatility? Take a look at the December SPY, which is the index on the it's the index on the Standard & Poor, but through the ETF. So basically, it's the same thing as the S&P, just as an ETF, and you're buying options on them. Now, right now, if I were to look at the ETF, and you could do that very easily on Yahoo Finance, it's not doing too bad. It's not too bad at all. If I look at SPY, right, and I say, hey, give me some options here. Okay, you want some option? Here we go. Let's take a look at the puts. If you look at the puts option for the S&P 500 or the ETF, basically, of the S&P 500, if you look at, I think I put a position of 520. I mean, right now we're at 529. Maybe we lose another 5%, right? It's possible. We may gain it back, but we may lose in the meantime. So 5% of 10% of 530, which is where the SPY is about 50. Let's take 25 away from it to make it half a percent by December. We are therefore at 500. If you look at the 500 right now, 500, 516, 500, 519 is up 66% today. The 520 is up 20%. The other one, the 521, is up 75%. The 523 is up 80%. In one day, you could make 80% in one day playing this volatility. Now, of course, you can't make it now because it's already up 80%. You have to do it before we have any kind of issue. You have to act before it's happening, right? So what you need to do right now is you need to make sure that you have enough cash to actually buy this stuff, right? So why should you listen to me? I'm not selling anything. Now you have to stop worrying, and play the volatility, right? Now this is in the immediacy, right? In the immediacy, you want to take advantage of it. Now, what else can you do? Well, you should also at some point, because don't worry too much about name by name, right? Because we're nitpicking what the Fed is going to do, what the Fed is not going to do. Now, keep in mind that these people online or whatever, their job is essentially that. Their job is to basically tell you what they think is happening every minute of the day. It's going to drive you crazy. I mean, if you look at some of the opinions that you have, some people say buy, some people say sell, some people say NVIDIA is overbought, some people say, no, that's the future, AI is the future. What do you do? What do you focus on? Play the volatility. Now, of course, you have to be extremely careful because these options expire in December, and the closest you get to December, the more value they drop. So this is the kind of thing you put an option, you look at it, you make your 50%, 80%, and you're out. Right? You don't want to stick around and say, well, let me wait, because the closer you get to the maturities in December, it disappears. Now, of course, you could be buying longer options, but then instead of making 80%, you make 50%. Not bad. Still, it's not the same. So that's what's happening in terms of volatility for short term. Now, long term, what do you do? Well, long term, I would suggest this. I mean, the Fed is definitely going to lower rates in September. That's a given. The problem is now, and this is what you have to get into the mind of the market, is the market now is starting to focus is, you have to lower rates because we're going through a recession. Why? But look at the rate. Look at what's happening with the unemployment. Well, that's only one number. And one thing you need to know about the Fed, most of the time they are wrong in the assumptions. Remember a couple of months ago they were expecting some decrease in inflation, and then inflation went up. Oops. So you need to look at this from a perspective that what's going to happen in the next couple of months. So play the volatility. Now, further down the line, what do you do for your retirement? What do you do for the portfolio that is more long term? That's more difficult. Now, obviously, if you take a look at the small caps, which is about a P of 10, which is half of what the S&P is, right? The S&P has run its course, maybe, right? I mean, even if they haven't, I mean, they're really, 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 really overbought, right? Well, because the P is at 20 and 25. Okay, but does that mean it's expensive? Well, I don't know, because technically we're looking at earnings per share. Earnings per share is not cash flow. So don't rely too much on this very simplistic figure. Say, oh, look, the Russell 2000, which is for small cap, is at 10. Oh, look, the S&P is at 20. Therefore, 10 is less than 20. Therefore, this is undervalued. Well, I mean, on that basis, which is basically based on what people are paying, but is it truly undervalued? I don't know. I mean, you have to look at cash flow. And if you don't look at cash flow, then you may have a problem, because cash flow is king. Unfortunately, there is no PE cash flow. There's PE earnings per share. They don't make it easy for you. What they make it easy for you is to turn the TV on or the YouTube and listen to all these people talking one way and then talking the other way. Meanwhile, you're listening to this, you're listening to that. That's the goal. We want you to listen. We want you to listen on both, so we could collect views, so we could collect advertising, so we could sell the product, and these people actually peddling their portfolio, telling you, hey, buy an NVIDIA because it's good, and they have NVIDIA in their portfolio, so they can. That's why they. What do you think they're wasting? They're spending their time talking to you for free. Everybody's making money out of you, and that's what's bothering me in this situation. That's why I'm trying to offer you. I mean, it's a class. I'm teaching you, essentially. That's what I'm doing here. I'm not, I mean, usually you don't see me peddling, hey, buy 10 stocks from these guys. I'm not doing that. I refuse to take any money from these people. Okay. I want to make sure that you understand. I want to make sure that you grasp what's happening. Okay. So we're going to have low rates. That's a given. Are we going to have a recession? Are we not going to have a recession? I mean, the U.S. economy is pretty strong. I mean, and let's not panic anyway. I mean, we went from 3.5% last year of unemployment to 4.5%. Whoa, it's 4.5%. Europe is living with 10% every day. And I don't see them jumping off the roof, right? So 5% is still okay, or 4.5%. I mean, that's not panic, right? But obviously, that's moving the markets. That's moving the valuation of your portfolio. That's moving your decision. That is confusing, right? So at the end of the day, what you want to do is you want to own a portfolio that is safe. What is safe? Well, I mean, just look at it. I mean, take a look at the video that I did this morning. I have two interesting stocks. Play around with the options, but be careful. That could burn you. But look long dated. Go long dated. Go for companies that are doing a business that you understand, and then look for a company that has strong cash flow, doesn't have too much debt, too much interest expense, right? Because rates are going to drop, right? And obviously the Fed doesn't want to drop too quickly, because if they go down 5, 4, 3, 2, 1, 0, and then you have a recession, what do you do then? Okay. Now, having said that, that gives the impression that the Fed is out there managing the economy, but that's not their job again. Like I said, they're just supposed to reduce inflation. And when you hear talks about them, they want to have a tool to manage the economy by lowering rates, I'm a little worried. And of course, that brings up a bigger topic, right? The bigger topic that you need to understand, right, is, well, what is the role of the Fed, right? And they have too much power at the end of the day. Way too much power. They didn't see the 2008 crisis. Now, the Fed is here for a good reason. I think in 2008, yes, they came in and gave us some liquidity. 2020, well, something happened. In 1929, right, they came in and lenders of last resort. So, but on a day-to-day basis, I don't think we want the Fed involved that much, because look at what everyone is talking about: the Fed, the rates, the rates, the inflation. Hold on, relax. You need to take the bigger picture. The bigger picture is you have, I think we just passed recently, $35 trillion worth of debt. That means at some point, what does that mean? It means that needs to be paid, right? So obviously you need lower rates, but that's okay, but you really need to bring it down. How do I bring that number down? I don't pay for it. Well, that's probably one way of doing it, but I wouldn't recommend. How do you bring that number down? How do you control 35 trillion? Well, you have to start paying it down. Not refinancing and just paying the interest. You got to pay it down. How do you do that? Raise taxes. Were you crazy? I don't want to hear about that. Now, the reason you need to hear about the 35 trillion is because you hear more and more about it. And that sucker cannot be removed easily. Politically, it's a hot potato. Nobody wants to touch it. You hear the other candidates talking about it? So you need to think about that 35 trillion. Now, it's not for Monday morning. It's not for next year. Is it for 10 years? Well, we don't have 10 years because we're running out of money to pay Social Security in 10 years. So between now and 10 years, that's how much time you have. And when that thing is going to hit, remember Greece? What happened to Greece? What happened to Greece? Well, basically, they overboard. They couldn't pay. And they were forced to raise their taxes. Bam! They also reduced the age of retirement, and the retirement people got less money. But you have no choice, because at some point, in that case, it was with the European Union that were forced. France in that kind of a situation right now. They overborrowed as well. They're going to have to face up to the ECB, and they've been lowering rates. In the U.S., it's us and whoever is refinancing our debt. What happens when they say, you know what, we're not giving you any more money? Okay, so how are you going to finance that deficit? Every year, in interest alone, you are paying for you could pay for the defense budget every year. So what do? Well, you don't have it anymore, so you can't borrow, so you got to cut. Or people that are going to retire, they say, you know what, we really can't give you the money this year. You're going to have to wait 2 or 3 years. Or we're going to have to raise your taxes, right? So that's a vicious cycle. And that kind of stuff, that cannot be resolved by just lowering rates. This is peanuts right now, lowering rates and worrying about if NVIDIA is going to be a $3 trillion company, a $2.5 trillion company. So keep that in the back of your mind. And the reason you need to keep in the back of your mind, you're going to need the money in less than 10 years. You need to realize you don't want to have a $3 million portfolio and then this thing hits. And then you end up with 1 million. Well, that can happen to me. It happened to people in 2000. It happened to people that were in NASDAQ, and they basically, NASDAQ went down 50%. It was a big bubble that just burst. It took 15 years to get that money back. Okay, so keep that in the back of your mind. I'm just teaching, I'm just telling you. I mean, don't worry about it right now, but worry for the future. Okay? So, at the end of the day, you want to make sure that your portfolio has a little bit of everything in it. And obviously, because we have inflation and we're going to live with inflation, you're going to have some gold in there. You need some gold. You're going to need some Bitcoin. Why do you need Bitcoin? Well, because at the end of the day, Bitcoin is a finite amount. Gold is a finite amount. Therefore, it's kind of a hedge. You can't print anymore. You can't make any more Bitcoin. You can't make any more gold. So therefore, you're capped. So that's a hedge against inflation. Don't want to get into much detail. For those of you that want action right now, then the best bet is go for some small stocks. I will be feeding it to you once in a while so you have a feel for it. I would definitely go for the small caps, but make sure that you know the kind of small caps you have, and make sure that you know what they're doing, and you make sure they are growing sufficiently. And also, of course, like I usually say, you have got to ask questions as to what is going on. So the message of the day is don't panic and take advantage of that volatility. We shall see. We shall see. I mean, our position right now in the S&P, I mean, in our portfolio of small caps, I mean, we are kind of taking we're kind of taking a hit today. I mean, all the positions are in the red, and the total gain, the day gain, is minus 3.74%. Of course, the S&P is at minus 2.28. So my 8 positions are kind of doing worse the S&P. So saying that, everybody is going for small stocks, I am. Even the Russell 2000 is down minus 3.9%. So I'm kind of matching the Russell 2000 here. Russell 2000 is mostly small company stocks. So as you could see, we haven't the Russell is still not doing as well as the S&P. This is probably they're thinking, but a recession is not good for small stocks. Well, it's not good for anyone, quite frankly. That's what you need to do, like what these hedge funds do, right? You need to do like a Spitznagle and Company do, and the guy that wrote the Black Swan, right? You need to basically short the market. Not a lot. I mean, don't forget. Today my position on the S&P 500, the short position is up 64% in one day, right? At 100, now I'm at market value is 110%. I mean, my total gain is 13%. For the day, I'm up 64%, right? So that's not too bad because I'm making up the loss from yesterday. So you need that buffer. That buffer all around, though. I'm up $404,000, up 35% with 1.7 million. Why not? But still, take advantage of the volatility. Do not panic. And I will see you in my next video. And don't forget, obviously, that wouldn't hurt if you like what you see and you subscribe, so I don't have to work for a living.